I recently covered Warner Brothers Discovery, or that opportunity, on this channel, and in their latest filings, I just realized that Seth Klarman's Baupost Group recently just took out a big position on the company. And so that's what I'm going to dive into in this video. So guys, smash that like button, subscribe if you're new, and of course drop a meow in that chat to help with that YouTube algorithm. You're watching More Money, let's get it. What's up guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this one. So you can see here, if you guys are not familiar with Seth Klarman, this guy is a legend in the value investing space. He's got $30 billion under management. Baupost is one of the largest hedge funds. However, that's not what he's famous for. He's famous for his book, Margin of Safety. It is a cult classic amongst investors. And I actually read that maybe like 10 or 15 years ago. I can't remember how long ago it was. And even back then it was selling for $2,000 a copy. So it's crazy. It really is a cult classic. And notice here that Seth Klarman's Baupost Group recently took out a position of 18 million shares of Warner Brothers Discovery. Now, with large hedge funds, I don't really care if they buy a particular security. What I care about is how concentrated that investment is when it's a very value-focused hedge fund. And so Baupost Group is one of those really heavy, like Warren Buffett type investors. And so of course I'm going to pay attention to anything that's on their sort of like top 10 list. And so you can see here, these are their holdings as of Q2 of this year. And their 10th largest position, of course they just entered it, is Warner Brothers Discovery. This is above Micron, Meta, and Amazon. So it's very interesting. Now, for some of you guys that are interested, they do also have a holding in Alphabet. They just reduced it slightly. It looks like they do believe in the chip space. They have a position in Intel. I have a model on Fiserv. I don't understand the opportunity there, so I never invested in it. And those other ones on the top of his list, I haven't really spent a lot of time looking into. But the thing that I do want to point out is that the number of super value investors that are starting to consolidate on this name is growing. You can see here that it's not just Seth Klarman. You can see Michael Burry's here, David Einhorn's here, Leon Cooperman is here, and Lee Ainsley are here. So there's quite a few super investors that are now consolidating on this name, and they're either initiating positions or adding to them in this environment. So what exactly is happening with Warner Brothers Discovery? Well, here's the story. AT&T has offloaded Warner Media and its debt to Discovery. And this has caused immense selling pressure because AT&T investors are likely to be dividend investors that are not interested in the new company, compounded by the fact that the new company had very rough Q2 2022 results. So you can see those two selling pressure items playing out in the share price here. You can see that originally you had this immense selling pressure, which pushed the security price down, but it sort of bottomed out in late July, early August, and in fact even started to increase. And that's actually when I made the video. And notice that the rough Q2 results brought the share price right back down to that $13.50 area. And so that's where it stands right now. But of course, rough Q3 and beyond results could continue to push this share price lower. And ultimately, you can see that it's down almost 50% year to date from when it started trading. Now, management did provide us with their estimate on sort of how they're forecasting their unlevered free cash flow. I see a lot of value in this. However, the one thing that I do want to point out is I always try to be balanced in my view of management estimates. I see value here, but I also see that it could potentially be a bit of a stretch with the profitability, the free cash flow as a percentage of revenue increasing from 10% in 2022 to 15% in 2030. So this is why I'm only entering with a huge margin of safety. I'm saying 70% there, but maybe around that 65%, maybe 60%. So just a huge margin of safety before I'm willing to buy the security. And so what does that mean? Well, you can see that I've actually been trying to sell this cash secured put at $2.75 per share for the January 19, 2024s, but up until now, there have been no takers. This could be a good way of entering this opportunity if you're looking for a large margin of safety. This particular investment has a purchase price of $9.75 per share. And I'm valuing it at approximately $30 per share, so you can see how low the share price is relative to its intrinsic value. And this position gives you an annualized premium yield of 15%. So overall, the market hasn't been as bad in 2022 for value type securities that I've been trying to go after. And so most of my CCP sales have remained out of the money with an average yield of approximately 20%. But this is why I say that valuations matter and why I felt it was so important to put out that free financial statement modeling classes earlier this year. And I'm going to think about offering those free financial statement modeling classes again, but I'm going to do it a little bit differently because a lot of people signed up for the classes and then they didn't show up. And so I'm going to find a different way of doing it. Maybe I might just make those free classes just available to the Patreon. I'll see. We'll figure out how we do that. But now, just looking at the January 2023 cash secured puts, if you're looking for a shorter dated opportunity with a similar net purchase price, there is an interesting opportunity here with the January 20 cash secured puts. At the $10 strike price, you can sell it for 75 cents a share in premium, and that would be an annualized yield of 17%. So there is something for you guys that look for shorter duration cash secured puts. Now, I do want to share the valuation with you guys, but note that the vast majority of you guys that watch this channel are not subscribed. So please take a second to subscribe to the channel to not miss out on any great content. Now let's move into the valuation. So you can see here that I'm valuing the company at approximately $30 per share, but note that the true annual free cash flow yield is higher than what I've calculated because management is not going to pay down 100% of the debt. However, I penalize everyone's valuation for debt equally, but I do understand that it's probably not the best way that you should be doing it. I also am just giving them a 10 times terminal multiple. So it's up to you guys how you guys want to think about this. Now, what do I mean about the debt not being paid down completely? You can see that management has a long-term leverage target of 2.5 times to 3 times, I think, adjusted EBITDA in this case. But note that they're not going to pay down that debt completely. So in terms of owners' earnings, you should forecast it from the perspective of they're only going to pay down the debt by approximately 40%, and then the rest of the cash is going to come out to you. But I penalize companies equally. I might change that as time goes on, but that's sort of how I valued them right now. And it just provides a second level of safety in my ultimate valuation. Now, how do you get access to that model that I've built out on this opportunity? Well, you can get access to all of those models at the lower tier of the Patreons. And I actually went over this opportunity in great detail, and you can get access to that video right here.